core inflation for the year and Q1 next year is also expected to remain contained. The MPC also noted that growth outlook remains resilient, supported by domestic drivers, despite weak demand. It is likely to get further support from a favorable monsoon, lower inflation, monetary easing, and the salubrious impact of the recent GST reforms. However, growth continues to be below our aspirations. Even though the growth projection for the current financial year is now being revised upwards, the forward-looking projections for Q3 and beyond are expected to be slightly lower than projected earlier. This is primarily due to trade-related headwinds, despite being partially offset by the impetus provided by the recent GST reforms. Summarizing, the MPC concluded that there has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth. However, the MPC noted that the impact of the front-loaded monetary policy actions and the recent fiscal measures is still playing out. The trade-related uncertainties are also unfolding. The MPC therefore considered it prudent to wait for the impact of policy actions to play out and for greater clarity to emerge before charting the next course of action. Accordingly, the MPC unanimously voted to keep the policy repo rate unchanged at 5.5% and also decided to retain the stance at neutral. I will now be dwelling in some detail about our assessment of growth and inflation which has gone into these MPC decisions. First of all, growth. Economic activity has remained resilient, with growth of real GDP surprising on the upside at 7.8% and GVA at 7.6% for Q1 this year. As suggested by high-frequency indicators available so far, domestic economic activity continues to sustain momentum even in Q2. Looking ahead, an above-normal monsoon, good progress of Kharif sowing, and adequate reservoir levels have further strengthened prospects of agriculture and rural demand. Buoyancy in services sector, coupled with steady employment conditions, are supportive of demand. This is expected to get a further boost from the rationalization of GST. Rising capacity utilization, conducive financial conditions, and improving domestic demand should continue to facilitate fixed investment. And competitiveness of the banking sector. 2, improving the flow of credit. 3, promoting ease of doing business. 4, simplifying foreign exchange management. 5, enhancing consumer satisfaction. And lastly, internationalization of the Indian rupee. First of all, I have a few measures for strengthening the resilience and competitiveness of the Indian banks. The ECL framework, the expected credit line framework of provisioning with prudential floors, is proposed to be made applicable to all scheduled commercial banks and all India financial institutions. You would recall earlier a discussion paper in this regard was issued. We propose to make these effective from 1st April 2027, therefore giving sufficient time to the regulated entities. Moreover, there will be a glide path till 2031, so effectively 5 years. This is to smoothen the one-time impact of higher provisioning, if any, on the existing books of some of the banks. Furthermore, it is proposed to make the revised Basel III capital adequacy norms effective for commercial banks, again from 1st April 2027. In furtherance of this, a draft of the standardized approach for credit risk shall be issued shortly. Under the revised approach, the proposed lower risk weights on certain segments are expected to reduce the overall capital requirements, particularly for MSMEs and residential real estate, including home loans. It may be recalled that capital requirements for operational risk have already been finalized in 2023, whereas the capital requirements for market risk under Pillar 1 of the Basel III guidelines are under finalization after receipt of comments from the public. All these measures we propose to make them effective from 1st April 2027. These measures will help align our guidelines with international standards adapted to our national conditions and priorities, and strengthen the capital adequacy framework for the banks and the all India financial institutions. 3. A draft circular on forms of business and prudential regulation for investment was issued in October last year. It has now been finalized after wide public consultations, and it will be issued shortly. The proposed regulatory restriction on overlap in the businesses undertaken by a bank and its group entities is being removed from the final guidelines. The strategic allocation of business streams among various group entities of a bank will be left to the wisdom of the bank boards. It is further proposed, this is my fourth proposal in this regard, to introduce risk-based deposit insurance premium. You are aware that today we are having a flat rate of premium for all banks, irrespective of size, irrespective of risk, at 12 paisa per 100 rupees of net deposits. We propose to bring in risk-based insurance premium. This will incentivize sound risk management by banks and reduce the premium to be paid by the better rated banks.